Welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. Today I wanted to talk about the business cycle. So, markets have been nothing if they haven't been volatile in recent trading sessions. And personally, I have been reducing leverage in my positions because the losses are starting to add up. I've also been zooming out on my charts just so that I can smooth out some of the short-term spikes in volatility. Now, from an academic viewpoint, it's fascinating to see markets move as fast and as far as they have been doing. But as an active market participant, I am acutely aware that trillions of dollars of wealth are being destroyed when these markets are moving like this. But times like these are also when I lean more towards letting macro fundamentals guide my trading decisions. Recently, my dashboard has been signaling support for the dollar after almost a week of sideways trading. Now, all other markets are signaling resistance in one form or another after similar sideways trading looking back about a week. This to me signals a risk-off sentiment. And the risk-off sentiment that appears to be emerging in markets to close out this trading week and to kick off next week will probably be highlighted by a breakout above last week's trading range for the dollar. There should also be subsequent breakdowns in the price of commodities like gold and oil, as well as inflation-sensitive assets like stocks and crypto. While bond yields can be expected to continue to move higher while the prices move lower. Now, these moves will realign short-term market trends with longer-term macro fundamentals and provide cover for traders like myself to take calculated risks. Fundamentally, inflation is still too high by most measures, and the Fed and other central banks are on the case. So that means rates will have to move higher from where they are currently in order to slow economic activity and fight inflation. Fundamentally, when economic activity slows, businesses earn less, they produce less, and they tend to fire more. And fundamentally, when businesses fire more than they hire, people tend to move around less, they travel less, they're not going to work, they have less discretionary income to buy services, so that reduces the demand for oil and gas. And finally, fundamentally, when central banks coordinate efforts to fight inflation, investors do not need inflation hedges like gold, Bitcoin, and even real estate. So those asset classes also see downward pressure on their prices. The business cycle is real, and it is in full effect. So because globally we're on the verge of an economic slowdown, macro fundamental guardrails can be especially helpful to both investors and traders alike when markets are both volatile and uncertain like we are experiencing now. This has been Katie Mark, your neighborhood financial economist, with another episode of IJS Speaks. As always, when in doubt, take profits.